Are you a business owner looking for ways to maximize your profits and minimize your tax burden? Then you don't want to miss this video. Understand the ins and outs of depreciation, including what is it, how it works, and most importantly, how you can take advantage of it. But before we jump in, don't forget to like, comment, and subscribe so you don't miss out on any game-changing information. And if you watch until the end, I will give you a new code section that is really going to help you amplify the situation. Now let's get after it. Depreciation is one of those things that allows you to recover the cost of your investment and physical assets, things that you can literally touch. If it's not a physical asset and it's an intangible asset, that is called amortization. Now, when we're talking about depreciation of assets, the types of things that you can depreciate are buildings, vehicles, equipment, furniture, laptops, things that you can really touch. And the benefit of depreciation is it allows you to reduce your overall tax bill. Say, for example, you go get a new building for your business, or you go get new equipment for your business. Say that piece of equipment costs you $30,000. In order for you to recover the cost of that equipment, our government doesn't just let you write off $30,000. You have to depreciate it over time. And that really means writing it off over time. So let's say, for example, if we buy a piece of equipment and that piece of equipment is going to last you 5 years, you would potentially write that off over straight line, 5 years, a straight line, the same amount every single year, you're going to write it off. So say if that equipment cost us $30,000 and we write it off over 5 years, we're going to take $6,000 per year. But that's straight line depreciation. You could also accelerate that depreciation by writing it off sooner than 5 years. And accelerated depreciation has all sorts of methods: double declining balance, units of production. There are several ways for you to accelerate depreciation and to write things off. You really want to understand the best method for you. But here's the thing: you gotta understand the difference between a capital expenditure and something that is just a repair that is not going to be written off over time. That's really important, because many of you think that if you go out and buy something that you can automatically write it off, but you cannot. Capitalizing expense versus expensing it out immediately. When you capitalize something, that means that, you know what? If I bought that car, and if that car was $30,000 or that equipment was $30,000, I can't just write it all off. That means I have an asset, and that's going to be what we call a balance sheet item. But here's the thing: when people's businesses are worth money, that is because they have assets, cash in the bank, equipment. Those are capital assets, meaning you can write them off over time, meaning they increase the value of your business, meaning it gives you equity in your business. If you expense it out every time you purchase something, you're going to lose out on equity in your business. Expensing means I'm writing it off immediately. The year I purchase it is the year I'm going to write it off. So if I purchase something for $5,000, I'm going to expense it in that year. I'm going to lower my income by $5,000. But if I capitalize it, I'm not going to lower my income. I'm going to depreciate it over time. And in our example of $30,000 being written off over 5 years, that means every year for the next 5 years, I'm going to write off $6,000. You also want to make sure you understand the difference between repairs and improvements. Let's go back to our piece of equipment that we purchased for $30,000. And let's say that I have to put a new engine in that piece of equipment, right? That's not considered a repair. That's a massive improvement, because it's going to extend the life longer than a year. Repairs are things like a flat tire, changing the oil, maybe changing a little piece of the equipment. Typically, repairs are less than $1,000. Improvements are typically for the betterment of something. Let's say that I purchase a piece of property. That is a capital asset. And let's say I decide that I am going to add on a room, or I'm going to change out the windows in that property. That's an improvement. That's not a repair. Improvements extend the life longer than a year. Repairs just mitigate a problem and it stops it from happening.
Problem solved.
That's what's really the deciding factor for you. And trust and believe IRS is going to be looking at your expenditures in the event of an audit. You want to make sure you capitalize if it needs to be capitalized, and you want to make sure you expense if it needs to be expensed. I also want you to realize there's opportunities when you can literally expense out 100% of what it is that you purchased in that particular year. But when you do that, you got to use code section 179 that allows you to expense out a capital asset in the same year. This information is so important to making sure that you minimize your overall tax liability, that you lower your overall taxable income. And here's something else I want to make sure that you understand. That when you are running your business and that is your only form of income, and when you need to go out and qualify for loans, qualify for homes, you want to understand that depreciation as a deduction can literally be your new best friend. Why? Because depreciation gets added back to income for loan qualifying purposes. That's right. So say, for example, you have net income of $100,000 and you take a big write-off of some equipment that maybe cost you $60,000. Your net profit, $100,000 less the $60,000, drops down to $40,000. Now you're getting ready to try to get a loan for your business or try to get a house or something of that nature. And the bank says, oh, your income is only $40,000. But if you took depreciation, that gets added back to income. And sometimes the bank doesn't even know that. So now that you know how to strategize around depreciation and how to make sure you are able to then add it back to income for purposes of qualifying for a loan. And here's the thing, my friends, when you know better, you gotta do better. You gotta manage your income and expenses according to your long range plan. And you also gotta manage the content that you take in so that you can educate yourself moving forward. That's why I want you to like, comment, and subscribe so I can keep you educated on all things business and tax.